everybody, for the Today Living class session. As you know, we are trying to global macro indicators, macroeconomic and macro finance perspective throughout the world and regional economies. And today I will try to cover the valuation of stock exchange because the real market indicators and the financial market are a little bit differentiated during, especially in volatile times, and especially in 2008 global financial crisis, COVID pandemic. For this reason, to understand what is happening behind the screen and in the kitchen, what is prepared for us, because people see regularly that Federal Reserve making, let's say, something in Federal Open Market Committee. They're making some session. They are saying that let's increase the interest rate for 5.5, or let's say during the COVID crisis, let's cut the interest rate for the zero lower bound. So what does this mean for the equities and stock exchange, financial market indicators? Because real market is something else. For instance, industrial production, machinery equipment, this is real, this is seen, but the valuation is something else. It is a little bit abstract, a little bit not really seen, but behind the screen, we have lots of metrics and mathematics and calculation as well. So today I will try to cover the valuation of the stock exchange and equities in financial market, like Nasdaq, like S&P 500, or Dow Jones, or Russell. We will try to understand how we can say something is cheaper or expensive. How can we decide to take a position in financial market? Whether we can earn money or we will lose huge money while taking a position. When is the right time to take position, or when is the correct time to solve it? For that reason, I will try to cover all the slides and presentation in approximately 40-45 minutes. Then at the last of the session, for 10-15 minutes, we are making a living brainstorming and making simultaneous question answer session. So during those time, you can take the microphone, you can ask all your questions in the site, also in global macro finance as well. During the presentation as well, you can write your question in chat site if you wonder something. And if I realize it, then I will try to answer simultaneously as well. Now let's start the S&P 500. This is a good graph. This is a marvelous graph, not good graph. This is showing the S&P 500 index at inflection point. As you see in the x-axis, this is the time series from 1996 until today, approximately 30 years. And this y-axis showing the price value of the S&P 500 price index. And in the box here, okay, this box is really important, not just really. This is absolutely important information is included here. While you're making decision on how you take position on investment, this box will be your guidance and light in the dark. Then, what this darkness can be shed light, and how can we interpret this into our investment decision? As you see, this line chart here, upside, and then here, go to a downside circle. And here, as you see again, a huge upside, because from 900, it is increasing 1,500, meaning approximately 80% increase. Huge increase, because if you take a position here, you will get the money here approximately 80%. And from here, as you see, and if you take a position in 1,500, then you will lose approximately half of your money just in 2 years. And if you take a position here, this means that from 900 to 4,500 in approximately 14 years, you will increase your investment and money 5 times from 900 to 4,500. So how we will interpret this equation, this line, and what is happening behind the screen? First of all, let me explain this decrease. This is exactly the time of the global financial crisis of 2008. So, financial market loves lots of things, but it hates on the top one thing. It is risk. Okay. Financial market like time, like earning, like money, but it hates from the risk. And even there is no risk, but a risk expectation in the near future, everybody solve everything. Everything is sold in financial equities, derivatives, hybrids, everything. And here, during the global financial crisis, there is a huge sell-off in the financial market. S&P 500 decreased from 1,500 to 900, approximately 45% decrease. And from then on, there will be no crisis. Just here, we have a shock in the, how can I say, the COVID crisis from 3,300, we decrease approximately to 2,400, meaning that there is a correction in the financial market because of the COVID financial crisis. Then, how the financial market indicators and S&P 500 start to increase after this reduction? Because there is a huge risk. If we encounter a problem in the financial market, generally the government authorities, but the best well-known authority is the central banks, take measures to fight with these type of risks in the financial market and to make people and investors a little bit relaxed and make their investment expectation a little bit better. So here, in the 2008 global financial crisis, the Federal Reserve government decreased their interest rate approximately to zero lower bound, 0.05. This means that please don't save money, because if you save money, you will not get any interest of payment in your deposits because I am decreasing the interest rate. So please consume, please buy everything. And then people and investors started to buy everything. Then S&P 500 started to increase because Fed decreased the interest rate. Okay, money is cheap. You can borrow and you can put investments. The cost of money is really low during this time. Okay, you can borrow. Then here, when we encounter the COVID pandemic problem, we also see that there's a huge market correction from here to here. Then again, not just the Federal Reserve Bank, but also the other big global central banks like the ECB, like the Bank of Japan, or like the sorry for this, like the other central banks, they started to decrease their interest rate to zero lower bound. Then they understand that by decreasing the interest rate, they can increase the expectation of the near future inflation because inflation goes down. If the inflation goes down, the GDP growth, gross domestic product of the country, also will shrink. So the inflation and the GDP growth correlation is a positive side. So if the inflation going down, the GDP will go down as well. So to increase the GDP and inflation, Fed started to cut the interest rate again. Then the valuation for the stock exchange increased from 2,100 till approximately 4,800, as you see, approximately twice higher than the initial stage. So what this box showing us and where should we take the position? First of all, please look at this first line, the index level. In 2000, it is 1,500. In 7 years, it is almost not changed. Anything not changed. Everything is almost same during 7 years. Then from 2007 to 2020, approximately in 13 years, we increased twice times higher. Then from here to here, approximately 50% increase again in just 2 years. And in 1 year, we almost decrease approximately 15% from 4,800, approximately 4,200. So what this PE ratio showing us and why this is a good indicator in the financial market. How we evaluate the price earning indicator. Okay, let me explain first. Then at the end of the session, I will try to explain while making the brainstorming in price earning ratio as well. The PE meaning price earning. This directly showing us that there's a company in the stock exchange and there is a price for it in the stock exchange. This is the price. This P reflects, okay, this P for the company's price in the stock exchange. And this E reflects for us that the company is earning in real sector. Okay, how the company making commercial, how the company making production and earning money. So this E, the earning, is showing the real value, and this price showing the market value. Okay, so the real value and market value should be fair, not differentiated so much. As you see here, the price earning ratio for the S&P 500 in 2000 approximately 25. And as you see here, in 2007, it is just 15. Then 19 in 2020, then 21 in 2022, and approximately 17 in 2023. So what does the price earning show us and how we interpret it? During these years, we can take an average of the price earning. As you see here, if we take a price earning average, it's approximately 19. Okay, for the price earning ratio during this period is approximately 19. So what does 25 then show us? If the average of the price earning is 19, and today, if the price earning for that company, for that stock or for that index is 25, higher than the average, because average is 19, and today it is 25, meaning that this stock or this index is expensive. Okay, no need to take a position, because if you take a position, you can lose huge money because it is expensive. It is not the correct time to take a position if the price earning is really higher than its historical average. Okay, so if the historical average is 19, and if I can catch the index at the 15 level, then this means that it is below the average. It is cheaper. It is an opportunity to buy and get huge money by taking a position in upside in the stock exchange or in this index. And the dividend yield. How can we interpret this dividend yield in financial terms? So when you see the dividend yield, what does this mean and how can we interpret this dividend yield into our terms? Dividend mean is this. Let's say Apple at the end of the year declare a financial statement, right? Then there's an income statement for the Apple, total sales and revenue, the cost of sales, the EBIT, then interest payment. Then at the below that there is a tax payment, and at the bottom we have net income for the Apple, right? This is an income statement for the Apple. They have revenue and they have some cost while earning those revenues, and at the end they have a net income. Let's say this year Apple net income is 300 billion. Okay, I'm just saying a number. This means that this net income 300 billion belongs to all shareholders, not just the Apple, all shareholders, because Apple is a company who is making operation in stock exchange as well. Okay, and it has lots of shareholders all around the world. And this 3 billion will be divided because it is a net income, net earning, profit. This net income, this profit, will be distributed to the shareholders. Okay, according to how much the percentage of my owning in that company. Let's say Elon Musk, okay, take a position, or let's say Steve Jobs, while opening the Apple, holding 25% of the sharing, meaning that this income, net income is 300 billion, and 25% belongs to Steve Jobs. This means that 75 billion of the net income will transfer to the Steve Jobs because he has a shareholder in this company. And let's say Dr. Lambert take a position in Apple stocks $1 million. Okay. And let's say Apple stocks in all around the world totally $1.5 trillion. So Dr. Lambert will get 1 million over $1 trillion share from that net profit and earning. And this net transfer, just think the Steve Jobs case, net profit is 300 billion, and Steve Jobs holding the 25% of the shares. Then 25% of the net profit, 300 billion, approximately 75 billion. Then this money will transfer to the Steve Jobs as a dividend yield. Okay, this net profit, according to your shareholding portion, will be transferred to you. And this is your dividend yield in that company. Every year, you will earn a dividend yield. I think also, Dr. Lambert opened a chat here. You can write all your comments, all your questions here while this living session. And also at the end of the session, we will try to give the microphone to all participants to answer their questions. And lastly, here we have, as you see, 10-year treasury yield. What is this? 10-year treasury yield always used in the financial metrics and valuation because it is showing the non-risky asset. It has no risk. S&P 500 has a risk. Apple has a risk. Companies has a risk. Governments has a risk. But 10-year treasury yield is a non-risky asset. It is fixed. There is no risk while you are taking a 10-year treasury yield. It is always paying a regular coupon payment for you, and at the end of the 10 year, you will get whole of your money. Okay, 10-year treasury yield is showing a benchmark for you, how you are risky from that band or how you are riskless from that band. Okay, it is a benchmark showing how you are risky because 10-year benchmark is non-risky. And if you are here, you are huge risk. If you are here, you are less risk than even the 10-year treasury bond. Let's go over the valuation metrics in the second slide. This is valuation measures for the PE ratio. Please look at the y-axis. What is it? It is forward price earning, meaning that next couple of years, how I'm making valuation on the price earning of the companies and in the S&P 500. As you see, for the 25 years, okay, for the 25 years, the average of the S&P 500 is just 16.70. Okay, it is 16.70. And today I'm almost the same, just 17. Okay, almost same, meaning that not cheaper, but not expensive. Let's say I'm here. Okay, I'm taking position here, meaning that the historical average is just 16. And today, if I take a position here, I will be around 23, meaning that it is really expensive for me to take a position S&P 500 at this point because it has a huge downside risk. And this KP showing capital expenditure, meaning that how much the company is making capital expenditure in stock exchange of the S&P 500 index. So you can see this is also a Shiller price earning ratio. It is a little bit different calculation from our basic initial price earning, but the logic is same. Just the calculation methodology is different, and it is giving the same direction. So if the CAPE, let's say, decreasing, the price earning decreases as well. Their correlation is almost same, but because of the methodology coming from the calculation, the numbers are different. As you see the dividend yield, meaning that 2% of the dividend is distributed every year from the stock to the shareholders. So even your price is same. Let's say Dr. Lambert buy an Amazon stock in the stock exchange, Nasdaq. And during 1 year, price never changed. This does not mean that Dr. Lambert does not earn any money. Price can be same, but because Dr. Lambert is a shareholder of the Amazon, at the end of the year, from the net profit, Dr. Lambert get a dividend yield. Okay, so 2% of dividend yield will be distributed to the Dr. Lambert because he is a shareholder of the Amazon. Keep in mind that price can be same, but you can be a rich man by just taking a dividend. Okay? And like the price earning, we have other good metrics who is used by the JP Morgan, Goldman Sachs, Morgan Stanley, HSBC, Citi, or UBS, all around the world. All investment banking companies, like even the BlackRock or PIMCO, using all these valuation metrics to decide whether its company is expensive or cheap, or to take a position in that company or in that stock. Okay, these are all the initial indicators while making decision on whether the companies and whether it is the right time to take a position on these companies or not. One of them is PB. PB is price to book ratio. P is price and book is book value, meaning that let's say in different parts of the world, Amazon have lots of factories, right? And the factory has a real value. So if I make a valuation for that factory, let's say it is $1 billion. And let's say Amazon have lots of cars to distribute to their shelters. So they have another valuation coming from the cars. So I'm adding all these cars, factories, everything. Then I'm deciding a book value for the Amazon. This is the book value of the Amazon. Then I have a price of the Amazon in Nasdaq. Then if the price to book ratio is higher than the historical average, meaning that my company is again expensive because this means that you have a factory, and as owner of the factory, you know that to build this factory is $1 billion. But investor for this company making valuation $2 billion in stock exchange. But the owner saying the real value is $1 billion to build again this factory. But investor miscalculating its valuation and price is $2 billion. So if the price book ratio is higher, meaning that investor is misunderstood or misleading their calculation. They are buying something expensive. Okay, it is not a fair price for them. So if the price to book ratio is higher than its historical average, let's say for the S&P 500 is 3.10, and today it is 3.60, meaning that it is a little bit expensive to take a position in S&P 500 today because its price to book value is higher than historical average. Okay, if I take a position in S&P 500 index, and if the market makers make a correction to real value of the companies, then I can even lose 20% of my money in the S&P 500 index. Then another one is P over CP, meaning that price to cash flow index. Cash flow is the real money a company or factory, a stock earning during the years or next couple of years. Let's say Dr. Lambert making production in their factory in Arizona, and his customer giving regular order to buy their products for the next 3 years. And let's say Dr. Lambert has lots of different customers all around the world, and they are making order and making payment for the Dr. Lambert products for the next 5 years. Then Dr. Lambert today know that how much money he will earn during the 5 years, right? Because he has order, he get upfront payment, he will just deliver the products to those customers. These 5 years, money, orders, and all these things are my cash flow. I will get this cash in the next couple of years. This is my cash flow. This is my real earning. And again, if my price is really higher than my cash flow, meaning that I'm earning a money, but investors supposing that I'm earning more than this money. This is not correct. My price to cash flow ratio has a fair value. As you see, it is historical average is 11, but today the investor making valuation in their 13th level, meaning that my price is higher than my cash flow, and I can lose money if I take a position here in the S&P 500 index again. So all these indicators, price earning, capital expenditure, dividend yield, price to book ratio, price to cash flow, all have same logic, meaning that if price earning ratio is higher for a company, price to book ratio will not be lower. Okay, price to book ratio will not be lower for that company. So if one indicator showing that to you, this company is expensive, other indicators will also show the same. Okay, you will not see from any other indicators this company is cheap. All will show that this company is expensive company. And here, as you see, the price earning ratio and equity return correlation analysis. On the left-hand side, I have a chart. And this chart is showing to me that forward price earning ratio and subsequent 1 year return. And how it is related? If the price earning ratio is increasing, my return decreasing. As you see in the red line, they have a negative correlation, right? So if price earning ratio increasing, what should I understand? The company is expensive. So if I take a position, I will lose the money. And if price earning going up, my return will go down. I will earn less money and even lose the money, right? And price earning ratio, as you see here, has a negative correlation with the 1 year return. As you see here, then I'm making this valuation metrics for price earning and 5-year annualized return. Again, meaning that if I calculate my 5-year earning with the price earning ratio, it has again a negative correlation, meaning that even I wait 5 years, if the price earning ratio increasing for that company, I will lose the money. If I take a value, the price earning ratio should be lower. Okay, should be lower after I take a position. Because meaning that if I take a position for the price earning, let's say 25, then price earning decreased to 15%. This means that earning increasing more than the prices. So my company getting huge profit, then I will get an earning. So price earning decreasing, meaning that I'm earning the money. Okay. And here, as you say, S&P 500 valuation dispersion. And this is how the spreads and volatility happening in the valuation dispersion between the 20th and 18th percentile. So I'm taking the 20th percentile and 18th percentile, and I'm taking how much a confidence interval I have while making evaluation. And as you see, the median S&P 500 price earning is around 16 on average, but today is 16.6. Again, it is expensive, as you see here. And the valuation spread, especially for the volatile times, as you see here, COVID times, as you see here, global financial crisis times, my dispersion band increasing and decreasing in a huge volatile sense. And when we go into dive of the kitchen behind the screen, how I can understand my price earning ratio is correct And this is a good indicator for a company, whether it is cheap or expensive. So here, as you see, on the top of the explanation, I have corporate earnings and sources of earning growth. And on the left-hand side, we have S&P 500. Let me check the question here. Okay. First, I have lots of questions here. Oh, okay. Denis Kazabua asking me that, Dr. Dogan, please explain more about the dividend yield. Okay. Let's say Dr. Lambert buy a position in Amazon stock. Okay. And let's say this valuation and this position is $1 million. Dr. Lambert has $1 million in his saving account and decided to buy Amazon stock, let's say with $10 per share in the stock exchange. And during 1 year, the price never changed, not increased to 11, not decreased to 8. It is again $10. This does not mean that your $1 million will be the same at the end of the year, because Amazon is a distributed, well-known online shopping, right? So they have an earning at the end of the year. They have a net profit. Then, according to my position, I will get a share from that net profit. Okay, let's say Amazon net profit at the end of the year, $3 billion. Then, according to my share, let's say, hang on a sec. Just give me 1 second.
Okay, everybody, we'll just wait a second here for Dr. Abdulkadir Dogan to return. So we have a question here. Is cryptocurrency exchange we see on internet the same as the normal stock market? And what is the difference? Interesting question. Is cryptocurrency a stock? Is there stock? And is it valued the same way as a stock? Because usually stock refers to businesses that get funding, but is a currency a business? Okay.
Here we
Dr.
are
Abdul
again.
Kadir, do you see that question?
Yes, here we are again.
Is the cryptocurrency exchange we see on the internet the same as a normal stock market?
No. Crypto is just a product like the United States dollar. Stock exchange give a right to become a shareholder. If you buy Amazon, you will be a shareholder of the Amazon, one of the owner of the Amazon. Yes, your share is low, but you are one of the owner of the Amazon. But in cryptocurrency, it is like the cash money. Do you see this? This is euro, right? The cryptocurrency is like this. It has no dividend income. It has no profit or something like that. It is same as gold. It is same as United States dollar. But stock is something else. Okay? Stock can pay profit to you at the end of the year. Even the price is same for that. But cryptocurrency is not giving a shareholder for you. It is like a gold. It is like a silver. It is like a United States dollar cash banknote. Okay. Let me proceed the presentation again.
Does that mean that cryptocurrency is sold in the commodity markets?
Exactly. By the way, first of all, the authorities should accept it as a direct commodity. For instance, if the Dr. Lambert wanna make the payment to me if he has a borrow from me with gold, I cannot say that you cannot pay your money with gold. They can send this as gold. Even they can't, he can go to the market, sell the gold directly, convert it to United States dollars, sent to me. Because all around the world, people and authorities accept gold as a currency. It is a medium of exchange, but crypto is not. For instance, you cannot pay your bills directly with cryptocurrency, right? But with your money. You can pay with your money, but not with cryptocurrencies. But we don't know what will happen in the after 2 years about the cryptocurrency. Maybe it will be like a United States dollar. We don't know still. But as I say, it has no there is no collateral. For instance, while Dr. Lambert making a payment, Amazon print a shareholder document for you, like buying a house. But for the cryptocurrency, we don't have a collateral. Okay, there is no collateral behind the scheme. Is the point is sufficiently clear? Okay, let me proceed for this with the corporate earnings and sources of the earning growth. S&P 500 earning per share. As you see here, S&P 500 on the left-hand side, earning per share graphs. And this is showing in the blue line consensus analyst estimate, meaning that all around the world, we have lots of analysts in the stock exchange, and they are trying to guess how much will be the earning per share at the end of the year. And this bar in the blue line showing the consensus. Then this green line showing us that what is the earning in recession? Okay. On the right-hand side, as you see, I have S&P 500 year-over-year EPS growth. EPS meaning earning per share. Okay. I have a share in stock exchange. And what is the earning for that? Earning per share growth. As you see here, during the crisis time, there is no earning and it's shrinking. In COVID times, there is no earning and it's shrinking. But after the crisis, earning per share is increasing in a huge amount, as you see here. So earning per share is another good indicator like price earning ratio while making the valuation metrics in the stock exchange. Please look at the left-hand side. This is S&P 500 profit margin, meaning that how much profit according to their sales. For instance, at the end of the year, let's say your net profit is 2 billion. Okay. And your total sales during the year is 300 billion. So 2 billion over 300 billion net income over your total sales will be your net profit margin, approximately 6%. So if net profit margin is higher for a company, this means that this company is producing a huge profit while making operation. So quarterly operating earnings sales here. And as you see, it is always shrinking during the crisis time, global financial crisis and COVID crisis. Then here we are. But if we look at the trend, please look at the trend here. Yes, there is some volatile periods, but if you take a position here, it is always upside. Okay? Then on the right-hand side, the S&P 500 operating margins by sector. Current operating margin versus historical range. What we mean by this? I have lots of different sectors in S&P 500. And as you see here, the real estate sector has a volatile price earning ratio, right? Operating margin. Their margin is really volatile, can even increase to 30%. But let's say for the healthcare sector, it is almost same, just between 10% and 12%. So this is communication services, consumer staples, consumer discretionary. All sector has an operating margin. And while deciding to take in which sector I will take a position, I will take a look at how their operating margin can be changed throughout the years. So first, I will decide to take a position in S&P 500 first. Okay, this is my priority. Then, after decided to take a position in S&P 500, then I will decide in which sector I will take a position. Because sector is also important. And I will look at the sector metrics while making my valuation as well. And on the left-hand side, here, I'm trying to look at the value versus growth, meaning that Apple is a huge value company. But let's say I have a startup. It is just produce new products this year. It has no previous products. It has no historical valuation. So this is a growth company. So while taking a position, I should also be careful about while I'm taking position on the value company or a growth company. So if you don't like risk, if you don't like lose money, if you don't like volatility in the financial market, you will always choose the value company like Microsoft, Apple, Amazon. But if you like huge volatility, if you like the risk loving person, you will be a growth company in the financial sector while taking a position. And here, as you see, small capitalized and large capitalized stocks, meaning that, as I say, Amazon is a large capitalized company. Its capitalization is above $1 trillion. But I have some startups and small companies, let's say 10 years history, and they have small capitalization in financial market. I should also take a look at their sector composition in real estate, utilities, materials, energy, consumer staples, industrial, communication services, consumer discretionary, financial, healthcare, and information technology. They have distributed large cap and small cap in each sector. For instance, let's look at this. In communication services, we have pretty low small capitalized companies. Okay, but in information technology, 13% of the companies is approximately small capitalized. On the right-hand side of the table, we have percentage of the unprofitable companies in the Russell. We will try to understand here the main metrics behind the screen, and we will try to understand what is happening directly into the company's valuation. And here on the below, interest rate coverage ratio. Interest rate coverage ratio is this. Let's say you have a company, and this company directly making a valuation and operation in the financial sector. And you have a sales for this company, right? All the turnover during the year, you have sales numbers. These sales numbers then directly converted, because let's say 1 billion sales you have. Then let's say cost of goods sales in this company is approximately 800 billion. And from 1 trillion to 800 billion, I have earning before interest and taxes. Look at this EBIT number. EBIT is earning before interest and taxes. Okay, there is no interest payment, there is no taxes. I'm just calculating my net earning. Then, from this net earning, I will make an interest payment for my loans in the banks, in the companies, etc. So, if my EBIT over interest rate expense is really high, I'm a really good company because I can pay all my interest expense with my net. But if the EBIT over interest rate margin, this is interest rate coverage ratio, is lower, meaning that I even cannot pay my interest payment with my net money. I have another borrowing. So this will be like a vicious circle for me. Annual return and intraday yield decline, as you see here in the graph. And this is showing, like as here, the volatility in the market and what is happening in the stock exchange. And as you come here, how much money during the year I'm earning and declining. And this red line showing how much it is declined, and this black line showing us how much increasing our earnings. And the global equity market on the left-hand side I have. This is directly showing the US, Europe, emerging market, Japan, United Kingdom, France, Canada, Germany, China, Taiwan, India, Brazil. All the companies, global equity market indicators. This is from their local currency, and this is showing the USD valuation. So if there is a differentiation between them, this means that government's currency appreciate or depreciate. Let's look at this one. For instance, if the United Kingdom local currency earning is 5.2%, but in the United States dollar it is 6.8%, meaning that GBP pound appreciate against United States dollar during this time. Okay, because if I calculate my earning in United States dollar, it is increasing. So the GBP is appreciating during this time as well. And here I have cycle of the US equity outperformance. And as you see here, I have lots of outperformance during even short couple of periods. From here to here, I have approximately 13 years, and it is approximately 287. Okay, 77 percentage increase. But even here, just in 6 years, I have the same increase. So sometimes market has a huge volatility and appreciation while making the evaluation metrics, and we have huge volatilities and huge net profit while taking a position in our investment decision. And here, when I come into the last two slides of my presentation, international valuation and dividend. Rather than the S&P 500, I have an international valuation and dividend yields as well. Here, the international price to earning discount versus United States. Okay, we are calculating the price earning according to the United States price earning. Then, as you see here, MSCI, this is Morgan Stanley indicator for all countries, excluding United States and S&P 500, and this is showing the price earning. And as you see here, price earning is really lower than their historical average. Historical average is minus 15%, but today I'm at minus 30%, meaning that MSCI index, while I'm excluding the United States, is really cheaper all around the world. So except United States, you can take position all around the world today. Okay, it is cheaper. An international difference in dividend yield. Dividend yield, as I said, is an important topic because you are earning money. Even the price of the stock is same throughout the year. At the end of the year, you will be paid as a dividend yield. And as you see, the dividend yield average is 1.2. And today I'm here around 1.7%, meaning that today companies paying huge dividend yield because their earning increasing. And if you take a position in those companies, the end of year earning in your pocket will be higher than the historical level. And last of my slide is international equity earning and valuation. As you see on the left-hand side, this is the global earning estimate for the Japan, China, emerging market, Europe, and the United States. And China's companies has a really global earning estimate higher than the Europe, Japan, or EM market. And the United States earning even today is really robust and resilient. As you see in the real market indicators in the United States, they have huge profit and earning as well. But EM and Japanese companies earning estimate is a little bit lower than the China and the US. And as you see here, if I look at how much volatile I am, 25-year range showing in the black bar, and 25-year average is here, the dashed line, and the blue line showing what I am currently. And if I am above the dashed line, meaning that I'm expensive, and if I'm below the dashed line, meaning it is cheaper. Japan is cheaper, okay? And Europe is almost fair. EM is almost fair. China is almost fair. But the US is expensive because it is above the dashed line. US is expensive, Japan is cheaper. Other is almost in a fair valuation metrics